Blink Charging just put out their Q3 earnings report, and the stock has jumped massively following these earnings. Originally, it was at $2.41 on November 9th, and the day after those earnings came out, it jumped all the way up to $3.32 per share, and it has continued climbing since then, currently at $3.43 per share with a market cap of $230 million. So we're going to take a look at these earnings to see why the stock has jumped so much, and then I'll share my thoughts on Blink and whether or not the stock is a good value right now. I'd like to cover a few of the slides from the investor presentation since there's a lot of good information consolidated into one place right here, but I will get into the financial statements shortly. Starting off, we've got $43.4 million of total revenue in the third quarter for Blink. That grew 152% year over year. And then they break it down to service revenue and network fees. They are missing, they're not showing their hardware revenue, which is the bulk of their revenue. So these are some more minor revenue categories for them, but I guess they wanted to highlight these two. I'm not sure why they didn't include the hardware sales here, but $6.7 million of the total revenue came from service revenue. That grew 119% year over year. And then $2 million came from network fees. That's up 36% year over year. And then their gross margin was at 29.5%. That was up 175 basis points from 1 year ago, although I do believe it has declined a bit quarter over quarter. Then they've got almost 6,000 chargers contracted, sold, and deployed. Based on the wording here, I believe they're still combining all of the different ownership models into this one number, which kind of doesn't really tell you too much about the progress or anything here, because some of these chargers Blink is owning themselves. Some of them they're selling to other customers that go on to own them. So all sorts of different models are being combined under this number. So I wouldn't give it too much weight, if that makes any sense. Then there was also 16.2 gigawatt hours dispersed on Blink's networks. These networks include Blink, SemaConnect, EB Charging, Blue Corner, everything that they have built themselves and have acquired. And based on the wording there, I believe this also includes chargers that they've sold to their customers, so they're not generating revenue on all of this electricity that's been dispersed, but it's just this is the amount of electricity that has gone through Blink's charging hardware, essentially. Moving on to the income statement itself, here you can see the actual product sales revenue number of $35 million. And then you've got those charging service revenues of $3.8 million, the network fees of $2 million there, and then those total revenues of $43.4 million. Moving on to the cost of revenues, the cost of product sales was $24.6 million. Cost of charging services was $566,000. Host provider fees cost was $2.4 million. Network fees cost was $407,000. Warranty and repairs and maintenance, $561,000. Car sharing services, I believe this ties into one of the acquisitions they made previously. I don't think this necessarily has to do with the core charging business. The cost of that was $931,000. Depreciation and amortization was $1.1 million. And their total cost of revenues were $30.6 million with a gross profit of $12.8 million. And the gross margin, of course, like we saw in the slideshow presentation earlier, that was at 29.5% for the third quarter. So overall, decent numbers here from Blink. Moving on to Blink's operating expenses. This is a very interesting section for Blink this quarter because of these two lines right here. We'll get to them in a second. But it starts off with compensation, $15.3 million. General and administrative expenses, $8.5 million. Other operating expenses, $5.4 million. But then we get to these impairments. Impairment of intangible assets and impairment of goodwill. These are tied to assets that are on the balance sheet. So basically on the balance sheet, which I'm going to scroll up to and show you right here, we've got intangible assets and then there's goodwill. And the intangible assets right now, these are at $17.2 million. Goodwill is at $144.9 million. But previously, these numbers were a lot higher, particularly the goodwill. This was a lot higher If you look at the previous quarter's balance sheet, this number was a lot higher. In fact, you'll notice that it was probably about $90 million higher, because they've taken these impairments. It's essentially like a loss on those assets that's no longer there in reality anymore. So they've taken an impairment charge of $5.1 million on intangible assets and almost $90 million on goodwill. This is obviously, that's a very significant number, and as you saw, a very significant portion of the goodwill that they have listed on their balance sheet. So these contributed, particularly the goodwill, that made up the bulk of their total operating expenses for the third quarter, and that's why you see this massive loss from operations compared to 1 year ago. Now, these impairment charges are a one-and-done situation. They are not reoccurring operating expenses like these other categories. So you can kind of exclude it from the total operating expenses to get a more realistic number there for the third quarter. And if you do so, you'll see that the operating expenses were about $29.3 million, which was actually pretty flat with where it was a year ago. Now, finally, for the income statement, we have other income and expenses. They had interest expense of $970,000, a gain on foreign exchange of $144,000, loss on extinguishment of notes payable of $1 million, other income of $608,000, and all of these brought their total other expenses to $1.2 million. And then they had their provision for income taxes, that was $807,000. So their net loss was $112.7 million in the third quarter. Again, a significant portion of that was due to just this one impairment charge for goodwill. But in the end, net loss per share was $1.74. So, on the surface, not that bad when you do exclude the impairment charges there. In fact, if you do exclude the impairment charges from their net loss, the net loss per share comes out to be about 29 cents per share, which would be a pretty decent improvement from where it was a year ago at 51 cents per share. Next up, we have the balance sheet, and right at the top, we've got cash and cash equivalents of $66.7 million. I would like you to keep in mind that this number has been boosted by sale of stock, so they have been diluting their shares to raise additional funds. So even though it looks like it is, this is a positive thing, of course, they've got more cash than they had 1 year ago. That is kind of artificial. It wasn't provided by the business itself. It was raised from the stock. So keep that in mind there. Accounts receivable was at $41.7 million. Inventory was $47.4 million. And prepaid expenses and other current assets totaled $5 million. So all of these brought Blink's total current assets to $160.8 million. Then they had some restricted cash of $74,000, obviously not that significant. Property and equipment came in at $34 million. This includes the chargers that they own themselves. And then there was operating lease right of use assets, $7.9 million. This ties into the chargers they own themselves because this is the land that they're leasing for those chargers that they're owning. Then they had the intangible assets, $17.3 million. Of course, we already saw on the income statement under the operating expenses that $5 or $6 million impairment charge to this line. And then goodwill, $144.9 million. Also, we saw that $90 million impairment charge there for the goodwill. Other assets, that came in at $654,000. And all of this combined brings their total assets to $365.6 million. Moving down to the liabilities, we've got current liabilities including accounts payable, which was at $30.1 million. Accrued expenses and other current liabilities, these were at $15.5 million. Notes payable were at $4.8 million. The current portion of operating lease liabilities was at $2.6 million. The current portion of financing lease liabilities, $1.2 million. Current portion of deferred revenue, $12.2 million. And all of those put together brings their total current liabilities up to $66.4 million. Then we've got contingent consideration. It was at $1.3 million. Consideration payable, $60.8 million. Operating lease liabilities, the non-current portion, that was at $6.3 million. Financing lease liabilities, non-current portion, $1.1 million. Deferred revenue, non-current portion, $9.7 million. And other liabilities at $350,000. All of these liabilities put together brought Blink's total liabilities up to $145.9 million. So now we've seen Blink's third quarter financials, but what about their future? And we've actually got some new guidance for the full year. They're raising their revenue target to $128 to $133 million, which is a pretty significant increase from what they were previously targeting, $110 to $120 million. On top of that, they're guiding for a gross margin of 30% plus for the full year. Keep in mind, it's been at 29.5% for the third quarter, and previously it was higher in the second quarter. So, the trend is kind of downwards, but I wouldn't be surprised if they do manage to hit that for the full year. Then we've got this bar graph showing their annual revenue growth these past few years, and the darker shaded section is the new additional revenue growth they are now targeting for 2023. And I think this increase in guidance I think this was one of the main factors driving the stock jumping as much as it has these past few days, is because a lot of, the EV industry, the sentiment is that things are going downhill, demand is falling off, and, things are just not working out. But for Blink, they are, here they are raising their revenue target from what they were previously expecting. So overall, it seems like things aren't going that bad at all for Blink as far as, revenue-wise. Profitability, they are still working on getting there, and that's what we've got here in this slide. They're targeting a positive adjusted EBITDA run rate by December of 2024. Whether or not they'll hit that is, that remains to be seen, but it's good to see that they do have this goal in place. So we'll have to keep track of that, monitor the progress there, and see if they manage to hit that by that deadline. So coming back to the stock, is Blink Charging a good investment right now? And personally, I think the answer is still a no, because there's still just a lot of risk involved with Blink. Obviously, we don't know when they will actually be able to hit profitability. They are targeting that adjusted EBITDA positive run rate by December of next year, which is still kind of a way out. It seems like they're still going to have to raise money, on the way there. So, whether that comes from debt or if it comes from stock dilution, I'm going to guess it would be from stock dilution. I believe they still have a fairly decent at-the-market offering that they have available to them. But, it seems like there's still going to be more funding that they're going to need to get to profitability. And there's also just, fundamentally, as far as the products themselves, Tesla is coming in and bringing, new features for their level 2 chargers, making it more viable to operate a charging business using Tesla's level 2 charging hardware. So I think that has implications not only for Blink, but also for ChargePoint, and other manufacturers of level 2 charging hardware. I recently made a video on this subject of Tesla getting more competitive in the charging industry. I did focus more on ChargePoint in that video, but since Blink has a fairly similar business model to ChargePoint, a lot of the information there will be very valuable for Blink shareholders as well. So be sure to check that video out. I'll see all of you over there, and thank you guys for watching.